Oh, good morning, everyone. Leela, Vibhu, Sanjay.
Morning, sir.
Good morning, Ayush. Good morning. Okay.
Good morning, sir.
Good morning. So I think last session we had covered quite a bit on Ind AS 19. We had discussed short-term employee benefits, and that you have your salaries, wages, and then we saw in detail short-term compensated absences, where you had accumulating and non-accumulating. Accumulating, you had vested as well as non-vested accumulating benefits. And after that, we moved into post-employment benefits, where we saw two types of benefits: defined contribution plan, defined benefit plan. Defined contribution, straightforward. It's something like your contribution to a provident fund, where the employer's responsibility is only to make the contribution, and the story ends there. Then the employee himself is responsible for whatever be the actuarial risk, or whatever be the investment risks or the return risks, whatever it is, the employee is responsible. In a defined benefit plan, the benefits are paid pursuant to a formula or pursuant to a guarantee. So the employer is actually liable to make the payment to the employee for whatever the amount that is committed under the plan formula. So typically this could involve payments that stretch beyond the conventional tenure of 1 year or 2 years. So what happens is, here we end up doing an actuarial estimate of what will be my valuation. Okay, so we had just entered this, and then we were seeing the various complexities involved, like mortality rates, disabilities, attrition rates, and you also have discount rates on the financial side, salary escalations. So all these are peculiar or typical adjustments that happen in the case of a defined benefit plan, because the horizon is vast. The horizon being vast, what happens is, you will have to accordingly record the expenses based on what is the expected amount that will be paid. So that is something which is a little complicated to handle. Okay. So we also saw a question on how the obligation should be built up, the discounting, and what is my current service cost, what is my finance cost, where how the entries will be posted. We need to show the build up in the service cost as well as the build up that happens due to the time value that is involved. So we had run through this with the help of an example also. And then we also saw what do you mean by past service cost in the last class, and what do you mean by settlement or curtailment, which we are now going to discuss a little bit in detail. Okay, so this was broadly what we had covered. Uh, Today we should be in a position to close the standard in the next 2 to 2.5 hours. And then, as I said, I'll need around 10 to 15 minutes to hopefully discuss the topic, the small topic that was left out in your ESOPs. Okay, that also is an employee benefit. All right. So with this brief revision, I think let us start. Before that, could you go through whatever we had discussed, everyone? Yes,
Yes,
I
sir.
yes. All right, you could go through. What about Leela, Sanjay?
Yes, sir.
All right. I had given some questions for homework. You could go through that. They were largely illustrations. None of it had great calculations to be done. So I hope you could handle those questions also. Yes, kahin par bhi there was no major question to be calculated, no calculation involved. Could you do that?
Yes, sir. It's more like theoretical questions based
More
on a
like,
single concept.
yes, yes. So I hope you had no major difficulties in that.
Yes, sir. No major difficulty.
No major. Leela, what about you, beta? You could do it.
Yes, sir, we can. I will do
You
it.
could do it. Very good. Very good. Okay. So Ayush and Sanjay, I hope you could also handle the questions. So now we come on to the next one. Uh, See, I had introduced a question in the previous class on similar lines. See, the point is we need to understand the concept. So when I have a question that traces you through the concept, it gives you ease of understanding. Okay. So last time, I think we saw one of the question where a professional was being compensated after a 6-year tenure for 45 lakhs. So now we come to a similar set of a question where this is based on a plan formula. Okay, there it was a guaranteed amount that would be paid. Here there is a plan formula that is there. So in your gratuity, what happens? Similarly, here also we are looking at the adjustment. Ratna Limited pays a lump sum benefit on termination of service equal to 1% of final salary for each year of service. Okay. The salary in year 1 is 1 crore, which is assumed to increase at 7% per year. Okay. So at the end of the service, 1% of final salary is the benefit. So this is your plan formula. Tell me, will this be a defined benefit plan or defined contribution plan?
Defined benefit plan.
Yes, because the manner of calculating the benefit is specified. And this onus is on the employer to give this money. Okay. So it is a defined benefit plan. Salary in year 1 is 1 crore, assumed to increase at 7% per year. Salary today being 1 crore, it is a fact. Assumed to increase at 7%, what it is? And I see the word assumed, what it is. It is an expectation. It is an expectation. In slightly accounting language, what it will become? It is an estimate. It is an estimate. In Ind AS 19 terms, अगर इसको बोलेंगे तो ये क्या हो गया? This becomes my assumption. कौन सा assumption? Sir, this becomes my actuarial assumption. This becomes my actuarial assumption. Yes, it is a financial assumption. It is a financial assumption that the salary will increase 7% per annum. Discount rate used is 10%. This is also an actuarial assumption. This is not a fact per se. This is drawn from the government yield rates at the reporting period. So that is also an actuarial assumption that we take. Show the buildup of the obligation in respect of an employee who is expected to leave at the end of year 5. So this is again an actuarial assumption. It could be either attrition assumption or it could be his remaining tenure of service. Whatever it is, he is expected to leave at the end of year 5. Ignore all other actuarial assumptions other than the given discount rate. So apart from this, please don't assume anything else. Okay. Ratna Limited wishes to revise the percentage of the benefit from 1% to 2.5%. Discuss the impact of this change if the benefit was revised at the end of year 2 or revised at the end of year 5. First of all, we will calculate the benefit. We will see how the obligation builds up. Okay? Then we'll come to revision of the benefit. Okay? So now, same question. Okay? The solution. Okay? Salary in year 1, 1 crore. No doubts here. Salary at the end of year 5. Every year, the increase is 7%. So 1.07, 1, 2, 3, 4. Many students make a mistake here. They will write 1.07 5 times. 5 times आप नहीं लिख सकते because 1 crore is for the first year. 1 crore into 1.07 for the second year, third year, fourth year, and fifth year. So many students typically they see 5, so they will write 1.07 raised to 5. That is incorrect. Okay. So salary assumed at the end of year 5 is 1.31 crores and cost of benefit on termination. So this is as per the plan formula. What is the plan formula? final salary multiplied by 1% for each year of service. So 5 years. So based on the plan formula, the company has to pay the employee 6,55,398 at the end of 5 years. Are we okay with the first part? Yes.
Yes, okay. Okay.
So we call this what? We call this as the ultimate cost of benefit. We call this as the ultimate cost of benefit. Matlab, based on my assumptions today, the ultimate cost of benefit to the company will be 6,55,398 rupees. Now tell me, is this benefit suddenly crystallizing in year 5 or crystallizing in year 1, or it should be gradually crystallized over a 5-year period?
Gradually crystallize.
Gradually crystallized. So what we do next is we attribute the benefit to the periods of service. How many years do I have? Sir, I have 5 years. So 6,55,398 divided by 5 if you do. Every year 1,31,080 is your apportionment. Is this my current service cost? 1,31,000. No, this is not your current service cost. This is just apportionment of the future value. क्या बोले? This is just apportionment of the future value. This is unit. In this case, 1 unit is equal to how much? 1 unit equals to 1,31,080 rupees. In the previous example, 1 unit was equal to 7,50,000 rupees, right? 45 lakh divided by 6. So this is equal to 1 unit. Now I need to do the discounting. Why? Because payment will happen at the end of year 5. Payment will happen at the end of year 5. So when I talk about measurement, opening obligation in year 1 is 0. Obviously, interest on that will be 0. Then end of year 1 to end of year 5. How many years? 5 years or 4 years?
4 years.
4 years. Perfect. So discounting rate will be 10% for the 4th year. Okay. This will be for the 3rd year, 2nd year, 1st year, and present value. Okay. So this is how your reverse discounting will apply. So now you will multiply the apportioned value with the discounting rate. So 1,31,080 into 0.683 gives you 89,529 rupees. This is the first year's current service cost as well as the closing obligation. This becomes your opening obligation. Interest on that at 10%, 8,953. 3rd year's discounting rate 0.7513. Discounting rate applicable for year 2 will be discounted by number of years being 3 because payment will happen at the end of the 3rd year. So 1,31,000 into 0.7513, 98,482. 1,96,964. Again, this becomes opening, so on and so forth. The calculation will flow such that at the end of the 5th year, the obligation comes to 6,55,398. Any doubt so far? Ayush, Vibhu, Sagar, Sanjay, Leela?
No, sir.
No, sir.
No doubts. Okay,
No, sir.
perfect. So accounting entries for this will be employee benefit expense 89,529 to provision for employee benefits. Even the finance cost, you will take it as an employee benefit. I have shown it separately so that there is a clarity for you that finance cost also gets captured. Okay, but that also forms a part of your employee benefits only. So this is your accounting treatment. So that takes care of the original plan. Now we come on to the revision. First, what is happening? There is a revision in the benefit from 1% to 2.5%. This benefit was revised at the end of year 2. Tell me one thing. Forget the concept for now. this benefit, is it within the control of employee, or it is just an estimate? What do you think?
It's
Just an estimate.
Within the, this is not an estimate. See what they are doing. They wish to revise the percentage of benefit. Is this within the control of the entity or outside the control of entity, and it is just an estimate?
it's an control in the control of entity, and entity want to just revise it.
Correct. So entity wants to revise this benefit. So therefore, this is something which is very much within the control of the entity. So can I say that this is not just an estimate? This is a fact. Do you agree with this? Do you agree? This is a
Yes, sir.
fact. This is a fact, number one. Now, in your public sector undertakings or central government appointments, these pay commissions keep on coming, right? What is pay commission? Basically, they revise your basic dearness allowance, that salary structure, they revise with retrospective effect. So now here also, year one, we estimated that we will be paying 1%. But now in year two, we actually want to give a revision at the rate of 2.5% in the plan terms. So instead of 1%, we should be giving 2.5%. So tell me one thing. When is this benefit going to start being applicable from? This benefit will be applicable from year two. I'm looking at the first case. Year one, did I know that this amendment would come? Answer is no. So year one accounting will be based on which assumption? Which plan? The 1% plan. Year two, I know that I will be moving to the 2.5% plan. So year two onwards, I will have to do the apportionment based on what? Based on the new plan. Based on the new plan. But tell me one thing. When I move from year 2 to year 4 or year 5 will be straightforward accrual year after year. No doubts on that. But when I move from year 1 to year 2, will it be just a straightforward accrual or will there be some differential amount? क्या लगता है आपको? Will there be a uniform accrual or will there be a differential amount? Come on. I don't want you to calculate anything. I'm just talking plain concepts. Will there be some differential amount that will come? See, 1 crore into 1.07 raised to 4, 1,31,07,960. If I go by 1%, this comes to 655,398. I am going at 2.5%. चलो ठीक है, ये कैलकुलेट कर लेते हैं. Okay, into 2.5%. So that comes to 3,27,699 into 5. Sorry, 1638,495. ठीक है. Now please pay attention. See, giving you the calculation is very easy. I do not want to give you the calculation directly. I want you to think. Year 1, accrual happened basis which rate? Basis which value?
1%.
Yes. Year 1, accrual happened basis 6,55,398. Year 2 to year 5, कौन से basis पे जाएगा? Which basis will be considered for accrual? Come on.
2.51.
2.5%. Bibhu, Sagar, Sanjay, everybody clear? Leela, all clear? Year 2 to year 5 benefit will accrue based on 2.5%. Is it okay?
Yes, okay.
Now just
Yes,
think
sir.
of it. Year 1, I accrued basis 1%. Year 2 to year 5, I have accrued basis 2.5%. If I do just this calculation, will I ever reach 16,38,000? Answer is no. Because 16,38,000 over a 5-year period will happen only if there is a uniform accrual. There isn't. First year हमने किया 1%. Second year onwards we are doing 2.5%. So what happens is between 1 to year 2 there is a jump in your estimate. There is a jump in your plan. The plan which was earlier at 1% will now be compensated at 2.5%. This jump which has happened, this has happened because of a change in the plan, because of a change in the plan, a modification in the plan. Now tell me one thing. This plan is modified effective year 2. But should I go to year 1 and modify my financial statements by treating it as a prior period error? Or should I treat it as a prospective impact, and whatever be the catch-up adjustment, should I give it in year 2? What do you think? Do I treat it as an error, or do I treat it as a change in terms and move forward from year 2 onwards?
Prospective.
Prospective. Treat it as a prospect. That is exactly what we are going to. Okay, so this is your new benefit. If I do the apportionment of the new benefit, it will be 3,27,699 per month. Okay, so this is 1 unit. This is 1 unit. Okay. Now, please pay attention. This, when I convert it into the obligation, again, I'm doing a straightforward 5-year accounting. Okay, 5-year calculation, not accounting. So, 4th year discounting, 3rd year discounting, 2nd year, 1st year, and this is the present value at the 5th year. Okay, so 3,27,000 into 0.683, 223, 246. This gets built up to 16,38,495. Till here, anybody has any doubts? Till here, anybody has any doubts? If I'm fast,
No, sir.
please pause me. Okay. Leela, all clear?
Clear, sir.
Okay. Sagar, Sanjay, सब
Clear.
ठीक है? Okay.
Clear.
Now see. Year 1, what did I account? Year 1 मैंने क्या account किया था? I have accounted 89,529 as my obligation. Correct? Yes or no?
Yes, yes, 89.
All right.
529.
Year 2, my closing obligation should be 4,92,410 based on the new calculation. But because I was doing the old calculation, my obligation would have been 1,96,964. Yes or no? Bolo?
Yes, sir.
Yes. So, year 2, the new obligation plugs, the new obligation puts it at 4,92,000 for the second year, the closing obligation. But till now in my books, I was in year 1. I was based on the 1% plan only. So therefore, the obligation would have been sitting at 1,96,964. Year 2 onwards, I will take the new plan, the 2.5% plan. But ये जो jump है 1,96,000 to 4,92,000, this difference, why is it happening? It is happening because of a plan change that has been initiated. This plan change is within the control of the organization, number one. And this plan change is operating right from the inception of the plan. This plan change is operating right from the inception of the plan. But it is introduced in year 2. So if I have to give a prospective effect, can I say that the differential between 4,90,000, that is the closing balance at the end of second year under the new plan, minus 1,96,964, which is the closing obligation at the end of the second year based on the original plan, this difference is treated as an expense of the current year. But इसको हम क्या बोलते हैं? We call it as a past service cost. We call it as a past service cost. Why past service cost? Because when I change the plan from 1% compensation to a 2.5% compensation, it would obviously be that the company is quite happy with the way the employees are working. So to reward them for the work that they have done and they will continue to do, that gap of 4,90,000 minus 1,96,000, that gap is effectively a compensation for services which they have already rendered. So that has to hit my P&L immediately. That has to hit my P&L immediately. Are we able to follow? Yes.
Yes.
Leela?
Yes, sir.
Yes, Ayush?
Yes, sir.
Okay. All right.
Yes, sir.
So this 2,95,000, this is nothing but 4,92,410 minus 1,96,964. Okay. This is closing balance year 2 as per new plan. Closing balance year 2 as per the old plan. This is a past service cost. This is a past service cost for the services that are already rendered in year 1 as well as up to the change of the plan. This is what is your past service cost. This will always go to the P&L. This will always go to the P&L. Of course, if you are constructing something, if it is an item of capital expenditure, you can take it there. But mostly it hits your P&L. Okay. So year 1, you would have passed the entry based on old plan. 89,529. You remember 89,529. Year 1, you would have passed this. Year 2, your employee benefit expenses. You would take 98,482. The finance cost you would have taken based on the old one, 8,953. And then you will book a past service cost of 2,95,446. Now by booking this, you are moving from the old plan to the new plan. So your closing provision for employee benefits will be, your provision for employee benefits will be credited with 4,02,000, bringing the total to 4,92,410. Are we able to follow? Yes. Are we
Yes.
able to follow?
Yes.
Yes, sir.
Yes, sir.
All right. Year 3 onwards, the new plan will start. So 2,70,000 will be accounted. 49,241 will be your finance cost. 3,20,000 will be the credit that will be given to employee benefits. Year 4, new plan. Year 5, again new plan. Is it okay? Yes.
Yes.
Yes, sir.
All right. Now, this is your model. This is the way the accounting will happen. So, a past service cost will be accounted immediately when it comes into force. Okay, because the services are already rendered. Acha. Now you tell me, if the benefit is changed at the end of year 5, when are you going to recognize the past service cost?
At the end only, the
At
differential
the
amount.
end of year 5. मतलब क्या होगा? Year 1 to year 4, will happen based on original plan. Year 5, your employee benefit expense as well as the finance cost will happen based on the old plan. You will have a past service cost debit which will hit the P&L, and that will bring your effective closing balance at 16,38,000 change. Okay, so that is how it is done. So you can see if the change happens at the end of year 5, then 1638,495 minus what is the obligation here? 655,398. Just check this. 9,83,097. This is going to hit your year 5 as a past service cost. Are we okay with this? Yes.
Yes, sir.
So year
Okay, sir.
1, this is happening as per old. Year 2 also old, old, old. This is old, this is old. This will be a catch up. So that will bring your total to the new obligation, that is 1638,495. Anybody has any doubts here, please ask. Anybody has any doubts here, please ask. No doubts? Shall we proceed further? Yes. Sagar, Sanjay, Bibhu, Ayush, Leela, shall we proceed further?
I have a
Yes, sir.
doubt on this catch up 9,83,097. Why don't we do it annually after year 2?
See, the plan is modified in year 5, Sanjay. Okay. So I cannot dream of something when it is not there. Okay. 1, 2, 3, 4. See, today right now you are able to see 9,83,000 and 5 years because it is academics. Put yourself in a practical situation. Year 1 may, I cannot dream that in year 5 the plan will be 2.5%. Right?
Right.
सेम फॉर ईयर 2, 3, 4. आपके पास एक ही प्लान है. यू हैव ओनली वन प्लान. बिकॉज यू हैव ओनली वन प्लान, आपको अकाउंटिंग उसी प्लान के हिसाब से करना पड़ेगा. ईयर 5 में प्लान चेंज हो रहा है, राइट? तो
Okay,
ईयर
got
5
it.
में वो चेंज का इफेक्ट आएगा.
Yeah, the change is happening at the end of year 5, given in
Yes.
question. Yes, right.
Yes, in this case. Otherwise, in the earlier case, benefit, the plan changed in year 2. So we took the impact in year 2 itself. Okay.
Yes, right.
All right. So that is why it is. Yes. Any other doubts?
No.
All right. Anybody else? See, I get where we come from. We come from the fact that, sir, year 5, the hit is very huge, 9,83,000. Your employee benefit every year is around 1,20,000 plus 30, in the range of 1.2 to 1.5 lakh. Here, all of a sudden, we will have 11 to 12 lakhs hit in the P&L. Let it be. You change the plan in year 5, so let it be. That is how it works, right? That is how it works. All right. ठीक है. So that takes care of this question. I hope it is clear. Okay. All right. So next we look at what do you mean by settlement. Settlement is a transaction which eliminates all obligations for part or all of the benefits provided under the benefit plan. I am basically settling with the employees. Payment of benefits to or on behalf of employees as per the plan and included in the actuarial assumptions. That is what your settlement means. Old plan, when I replace it with the new plan, it is not a settlement. It is not a settlement. It is a modification. Okay, new plan with benefits same in substance, then it is not a settlement. Okay, so now plan terminated is obligation settled plus cessation of the plan. Okay, termination means अभी plan है ही नहीं. Okay, so basically जो भी obligation था that gets settled and the plan ceases to exist. Okay. Whether I have a plan amendment, I saw 1% to 2.5%. Curtailment, reduction in number of people who can avail the benefit. So I will give some compensation. Or settlement. Settlement means eliminating all the obligation by making payouts. Okay. When any of these three things happen, recognize and measure any past service cost or gain or loss on settlement. As per para so and so वो कुछ नहीं है. It is saying take it to the P&L immediately. Don't even wait. Don't even do a smoothing. It is saying any past service cost, gain or loss on settlement, book immediately to the P&L. चाहे वो कितना भी बड़ा क्यों ना, you will have to take that impact. You will have to take that impact. Okay, next. After the plan amendment, curtailment or settlement, the entity shall determine the effect of asset ceiling and recognize any change in that effect as per 57C. What is asset ceiling? I'll come later. Okay, but अभी के लिए सिर्फ इतना याद रखो, you recognize the past service cost or gain or loss on settlement immediately. Right now, just understand that. Okay. So gain or loss on settlement is nothing but the closing balance of the defined benefit obligation on the date of settlement versus the settlement price. This is the gain or loss on settlement. We have a question, we will see that in that. Okay, देखेंगे उसको. All right, next. So which discount rate to use? This is all everything the same. Which discount rate to use? Market yields at the end of the reporting period on government bonds. This is very clear. For currencies other than INR, you have a foreign subsidiary, you have employees who are outside where you are compensating under those rules. Okay. Then you will do based on high quality corporate bonds. You will do the discounting based on high quality or no asset backing. एक को बोलते funded, एक को बोलते non-funded. What do you mean by non-funded? I will go on booking the obligation, but I will not create a fund for it. I will not create a fund for it. Means what? A non-funded obligation means what? See, in all these entries which...
No.
No, sir.
No. अब क्या कर रहे हो? You are just going on posting entries in your software, in your ERP. You will tell your finance team, ठीक है, book करो, book करो, book करो. You'll go on booking entries. But there will come a time when you have to settle it. That is at the end of the 5th year. You have to settle. At that time, you cannot say book entry say we will settle. No. Settlement is a thing that you should do it in cash. So 16 lakhs paying all of a sudden is a huge liability. Okay. Today you are seeing 16 lakhs, bologe kya hai 16 lakhs. But suppose extrapolate it to thousands of employees or 100. This is only one employee 16 lakhs. Suppose 100 employees are there. Then 16 lakhs into 100. Kitna hoga? 1.6, 16 crores. Who will keep 16 crores liquidity? So for that reason, you can also have what they call a funded plan. A funded plan. Acha, Ind AS 19 does not mandate you to have a funded plan. Ind AS 19 tells if you have a non-funded plan, go on accruing the obligation. But if you have a funded plan, the accounting for that is mentioned separately. The accounting for that should happen as per the standard. So funded plan or unfunded plan. Non-funded, you will make a provision which are basically non-cash provisions. Cash is not set aside. Risk of cash not available at the time of payment of the defined benefit obligation. This risk is always there. So you will have to sell something, do something XYZ, and then you will have to make the payment. But hypothetically, or not hypothetically, practically, you may have certain companies, and most of them follow this. They fund it. They fund it. Fund it means what? They will create not only a non-cash provision, but they will set aside money. They will set aside money. This money would be set aside by parking it in government securities or deposits. You will, it's not like you will park it in the share market. Yes, you park it because the purpose of this is to pay off the liabilities to your employees. This is not for you to gain benefit out of that. Okay, ये उनका पैसा है. So intention is to make sure the cash is available when the liability is due. So we have an obligation and we have an asset. Two things come out of this. Okay. How can what is the mode of investment? There are two types, broadly speaking. One is create a separate fund, a separate entity, a separate trust, an employee trust or employee plan. Create a separate legal entity, go on parking money there. Go on parking money there. Okay. This investments are held by this entity. See, if you put it in your own entity, you only will end up and use it, which is why the recommended thing is what? You park it in a separate legal entity. You create an employees benefit trust, transfer money to that trust, and from that trust you do the investment. Sir, तो फिर हम ट्रस्ट से पैसे निकाल सकते नहीं. You cannot draw the money from the trust for company benefit. That money is exclusively for employees. Those investments are exclusively for employees. These investments are to be used solely for payment or funding of employee benefits. This is one manner of handling the funding. Second manner, take a qualifying insurance policy by an unrelated party. Proceeds of the policy on maturity or whenever employee leaves, retires, resigns, superannuates, or whatever be the case, proceeds of the policy will be used solely for payment or funding of employee benefits under the defined benefit plans. Whatever be the mode, understand that these are not available even to the creditors at the time of bankruptcy. Employees will come under preferential creditors along with, just after state dues, state government dues, taxes, rates, etc., etc. Just uske baad you have your dues to employees and then you have your dues to creditors. Are we okay with this? Yes. Did you understand the concept of plan assets?
Yes, yes, understood.
All right.
Yes, sir.
Fine. So now, very simple questions. You have small questions. Okay. So we'll just run through this. Compute the actual return on plan assets. So how does a plan asset function? See, today I made a provision. Let us say my provision for post-employment benefit is 10 lakhs. This 10 lakhs, I will take it and I will park it in the plan asset. Okay. Next year, another 10 lakh. So that 10 lakh also I will park. So now I have 20 lakh on the asset side, 20 lakh on the liability side. Tomorrow, suppose an employee retires or resigns, whatever it is. And basis his resignation or retirement, he has to be paid 5 lakh rupees. So when he has to be paid 5 lakh rupees, what will happen is my obligation value is 20 lakhs. Out of that, I have to pay 5 lakhs. So 20 minus 5, the closing obligation will be 15. But will I pay 5 lakh? Answer is no. It is the fund which will pay the 5 lakhs. So fund is sitting at 20. Out of 25 lakh, fund value also will go down. My obligation also will go down. So therefore, both will go down and they will sit as 15 lakh at the end of the third year. Are you able to follow? Yes? Yes?
Yes, sir.
Both will drop. Fund also will drop. and the plan asset value also. I mean, the fund, that is the plan asset value, also will drop, and the obligation also will drop. So that is how the system works. Acha, is it necessary to park an amount in the fund always equal to the obligation value? Answer is no. You can just park any amount that you want. Say, for example, you take a call. Whatever is my provision, 85% of that I will set aside. 15% to cash rahega. See, the point is this. Today you are seeing 16 lakhs for one employee. When it becomes 16 crores, that is hard cash which I am setting aside. And uska mere liye koi benefit nahi hai. So if I put aside 16 crores, what am I going to do? So instead of 16 crores, you can say that up to 75%, 3/4 of that maybe arises. If there is a shortfall, I will settle. So that is how the whole thing plays out. Is it okay? Yes. You can take a call. Okay. 75% is an ad hoc figure. Somebody may say 85%, somebody may say 90%, somebody may say 50%. It's all your choice.
And there would be compounding
Depending on your,
also on this amount.
What happened?
I said there would be compounding also on that amount, so it will build up over the time.
Yes, you mean to say the deposited amount, right?
Deposited amount, yes.
Yes, compounding will happen, but it will sit in that trust. You will not get anything out of it. Okay. You cannot see, if you say I will put an FD in my own books, वो plan asset नहीं हुआ, वो तुम्हारा asset हुआ. It is your asset, right? You can anytime draw that fixed asset and use it for something else. Kal ko you want to put a huge plant, you need capex, you need money for capex. You will say draw that money, pay it as margin. फिर employee का क्या? वो बेचारा ऐसे ही बैठेगा, right? So basically the intention of a plan asset is take out your control over that fund. That is how plan assets work. Okay. All right. Fine. So shall we continue?
Yes, yes.
All right. So from the following, compute the actual return on plan assets in respect of a company for the year ended March 2020. Benefits paid, employer's contribution, fair market value at the end, fair market value at the beginning. Straightforward here, nothing else is there to be done. See, fair market value at the beginning, 20 lakhs. This will always be at fair value. Okay. Closing balance is 28 lakh 50. Straight T form accounting. Okay. When employers contribute, fund value increases. So they contribute to the fund. So plan assets account debit to cash bank, which is employer's contribution, 7 lakhs. 5 lakhs is something which is paid. So defined benefit obligations account debit to plan assets. So 5 lakhs paid out. So when you do this, 6 lakh 50 is your balancing figure. This is your actual return on plan assets. This is your actual return on plan assets. Any doubts? Don't say there is any doubt here. Okay, it's mutually
No doubt.
embarrassing. Okay? Yes.
Yes.
All right. Don't take it seriously. If you have any doubts, please feel free to ask. Okay. यही चीज in textbooks you will have it in a statement form. So statement form by heart mat karo. I am very comfortable with the T form. If you are comfortable with the T form, there is no harm. You can go ahead with a T form account. Okay. All right. So that takes care of this question. The whole point is to make you understand how the accounting happens. Okay. Now, how do I present in the financials? In my financials, I will net off the obligation and the plan assets. I will net it off. Why? Because they are legally going to be used against each other. The plan asset is only for the employee obligation. So if you see your Ind AS 1 net setting presentation, If at any point of time there is any asset or liability which can be net setted off against each other, you will have to present it as such. Okay. So present value of the obligation minus fair value of plan assets, which is either a long-term fund or insurance policies. When you calculate this, the net deficit or surplus, if it is a deficit, it becomes a net defined benefit liability. If it is a surplus, it becomes a net defined benefit asset. Are we okay with this? Yes. Are we okay?
Yes, okay.
All right. Now, you can go through this for homework. If entity has more than one plan, separately apply the procedures for each plan, obviously. Encouraged to use a qualified actuary, not mandated. At least recommendation is there. AS15 did not have a recommendation. We were using it nonetheless. Okay. Para 59, valuation to be done before end of reporting period and results updated up to the end of the reporting period. Estimates averages may provide reliable approximation in some cases. Account for both legal as well as constructive obligations. Okay. Are we okay with this? Are we okay with this? Yes. Any doubts so far? Yes, if theory hai. Okay. All right. If the present value of defined obligation, that is liability minus asset, is positive. If liability minus asset is positive, that is obligation greater than asset, we call it as deficit. And this sits as a net defined benefit liability. Entire deficit is recognized in the balance sheet as a provision. Why do we call it as a provision? Why do we not call it as a liability? Provision और liability में क्या फर्क है? Can anybody tell me what is the difference between provision and a liability? Go ahead,
We are
Ayush.
calling it provision because the amount is not fixed. Yet we know that we have to pay in future, but how much is not fixed.
Yes, so there is an uncertainty as far as the amount is concerned. That is why it is an estimated value. It is not a defined value. So we call it as a provision. Very good. Okay. So provisions, we show it under non-current liabilities. Okay. Then suppose I have a net defined benefit asset under one plan and a liability under another plan. Can I do net setting? If it is legally enforceable and intends to settle on net basis or realize surplus in one plan and settle obligation in plan B simultaneously. If only these two conditions exist, only then you can do a net setting. Otherwise, plan B liability will be shown as a provision. Plan A liability will be shown as a non-current asset. Are we okay with this? Yes? ठीक है. What if
So, sir,
it is negative? That means asset is greater than obligation. I went on putting money and today I note उतना obligation है ही नहीं जितना मेरा asset है. So we call this as a surplus. It becomes net defined benefit asset. And this is recognized in the balance sheet at the least of surplus as computed above, that is your obligation minus plan assets fair value. So as computed above or asset ceiling. So lower of actual value or asset ceiling. Okay. What do you mean by asset ceiling? Present value of any economic benefits available in the form of refunds from the plan or reductions in future contribution to the plan. So this is your present value of any economic benefits which is available in the form of refunds. That is known as your asset ceiling, or in the form of reduced future contributions to the plan. उसको हम लोग बोलते हैं asset ceiling. So your net defined benefit asset calculation, where you are calculating the surplus, it is restricted to asset ceiling value. It is restricted to asset ceiling value. Are we okay with this? Yes.
Sir, can
बोलिए.
you please explain again the asset ceiling? I was unable to
See,
get.
what happens is, okay, is there a question? Yes, there is a question. We will see the question and then you can understand. Okay, we'll see the question and then hopefully you should be able to understand. Okay,
Yeah, sure, sir.
so let us start. These two chote questions and you don't even need to see the solution. Okay, now how will the following information be presented in the balance sheet? Present value of defined benefit obligation 3,500. This is your liability. Fair value of plan assets. This is your asset. How are you going to present? आप net off करोगे. 3,500 minus 3,332. 168. Liability is more, so this becomes a net defined benefit obligation. Are we okay with this? Yes. Are we okay?
Yes, sir.
All right. Now, see, how will the following information be presented? Again, same. 2,750 is your liability. Plan assets is 2,975. So 2,750 minus 2,975. This comes to 225. This comes to 225. Okay. See, as per your plain book values of obligation and fair value of plan assets, the fair value of plan assets, you need to recognize a net asset of 225. You need to recognize an asset of 225. But there is an asset ceiling of 175. That means what? It means, see, it looks like this. See, this plan asset typically is a trust. Okay? This trust, abhi trust matlab it won't be just a piece of paper, right? Trust ka matlab, trust will have its own employees who will manage the investments. It will have its own administration charges. It will have its own other operating expenses and it will have its own taxation. Yes or no? Bolo.
Yes, sir.
ट्रस्ट का ये सब चीजें तो होगा और इट विल बी एन ऑपरेटिंग ट्रस्ट. ओके, नाउ टू मीट ऑल दीज एक्सपेंसेस इट नीड्स मनी. उसको पैसे चाहिए. पैसे कहां से मिलेंगे? द रिटर्न ऑन दोज एसेट्स विच इट हैज इन्वेस्टेड. यस और नो? द ट्रस्ट इज पार्किंग मनी इन इन्वेस्टमेंट्स. Investment will give a return to the trust. Out of the returns, the trust operates its own expenses also. Yes, which is for the benefit of the employees. Now, think about it. Can I sell all the assets of the trust, all the investments to meet my obligations? Or should I keep some amount of assets sufficient to meet the expenses of the trust? बोलो.
Some amount should be left for
You
the
have to keep some
administration and
amount.
working.
रखना ही पड़ेगा आपको, नहीं तो वो ट्रस्ट कैसे चलेगा? Yes, you cannot keep on funding that operation, right? So you will park it in some assets that will be invested. Through the return on those investments, the trust operates. And therefore, your usable amount is known as asset ceiling. Your usable amount from those assets is known as asset ceiling. Okay. So what happens is, see, PV of any economic benefits available in the form of refunds from the plan. That means you can pull out that money for your obligation, or you can reduce your future contribution to the plan. That effectively becomes your asset ceiling. That effectively becomes your asset ceiling. Are you okay? Yes? Is it clear?
Like, sir, in the meaning of reduction, like we are reducing our own contribution. The company is
That's
reducing
what.
its
So क्या
contribution.
होगा? Suppose in 1 year you had surplus cash. You put that money in the employee trust. Next year you need not put so much of amount. So you are utilizing the balance in that trust to reduce your future contributions. Yes,
Yes, sir. So it might also be possible that the fair value of asset has increased double fold or triple fold in 2 to 3
definitely.
years. So
Definitely. But
we
again,
don't
that's
need
what
to
I'm
do anything.
telling. You will not put this money in risky securities. What you are saying hypothetically is possible. If you put it in bitcoins, cryptos, if you put it in startups, if you put it in what you say, equities, what you are saying will happen. But will you put this money in those assets?
No, sir. There should be
आप
less
नहीं
risk.
करोगे ये आपका पैसा नहीं है दिस इज फॉर द बेनिफिट ऑफ द एम्प्लॉयज you will put it in assets which give a stable yield because what happens here is protection of the principal is more important. You are not here to profit out of those assets. Okay.
Yes, sir. Let's say my reduction is, let's say every year I was contributing rupees 100, and due to the returns I've earned on my asset, the fair value has increased, and my
Yes,
reduction is now reduced to rupees 80 only.
your
So,
reduction is now reduced to
rupees 80 only. It was rupees 100 per year earlier, but now it is
sorry,
rupees 80 only,
आपका contribution.
my contribution. So,
Yes,
in that case, my asset ceiling would be the present value of that rupees 20, the
see that
differential.
80 whatever, see you have parked 100. You have parked 100 earlier year, correct?
Right, sir.
Now, after the whole year has gone, maybe some of your employees left for whom gratuity was not applicable. They left, but your asset values are still there. Now, for the remaining employees, you had to contribute only 80, but you have a balance of 100. So, will you do any contribution? Either you can pull it out or you can say, no, I will not do any contribution. Last year I made 100. This year I need not make any contribution. That is what becomes your asset ceiling. You are unable, you need not make any contribution to meet your liability. Are you able to follow?
Yes, sir, to some extent. Now we can do it some in the form of question. Maybe that would clarify
Okay, let us
better.
see. We will see that.
Right.
Okay, we will
Yes.
see this. Okay, all
Right.
right.
Thank you, sir.
I will touch this. Okay, all right, fine. Anyways, these two things are done. All right. See this asset ceiling, you will have to give me some time. Maybe post the break, I will be able to discuss because the way you want a question that is not framed as of now. I will frame something during the break when I'm going to give. That time, I think we should be able to understand better. Okay. All right.
Yes, sir. Thank you, sir.
Yes, yes, yes. All right. ठीक है. So now, step one, what we saw recognizing the ultimate cost of benefit. Step 2, we saw recognition in the balance sheet. Step 3, what do I recognize in the P&L? What do I recognize in the P&L? In the P&L, I recognize service cost. You all agree to this? What is my service cost? Current service cost. Then I recognize past service cost. Then I recognize gain or loss on settlement. Past service cost could arise due to plan amendment. We saw 1% became 2.5%. we will see curtailment. We will see curtailment. Okay. All these items get recognized in the P&L. All these items get recognized in the P&L. Next, there is net interest on the net defined benefit liability or asset. What do you mean by net interest? Change during the period in the net defined benefit liability or asset that arises from passage of time. See, we did the build-up of the obligation. In the build-up of obligation, there was a row mentioning finance cost or interest charges. Do you recollect? Yes.
Yes, sir.
That is
Yes.
your interest on defined obligation, which is happening only due to passage of time. Similarly, you park your money in plan assets as uh, an asset available to settle your obligation. That also will earn some interest. That also will earn some interest. The difference between interest paid and interest earned is your net interest, is your net interest on the defined benefit liability or asset. This also will go to the P&L. This also will go to the P&L. Apart from this, there is principal value plus interest. Ideally, this should become your closing balance. But there is a different fair value also. The difference between the fair value and the closing balance becomes your remeasurement of the net defined benefit liability or asset. Are you able to follow? Yes? समझ में आ रहा है? See, ideally, if I park my money in fixed assets, or let us say if I park my money in high quality corporate bonds, which are traded in the market. So, 1,000 rupee bond with 15% interest. So, 1,000 plus 15%, my closing balance should be 1,150. But these bonds are so much in demand that the fair value is 1,200. That means you are getting two returns here. One return is 150 interest and 50 rupees fair value movement. Yes or no? Bolo.
Yes, sir.
So this is your return on plan assets. This is your return on plan assets. Apart from interest, over and above interest जो मिल रहा है, this is your return on plan assets. Similarly, I will be having something known as change that happens, remeasurement that happens due to actuarial gains or losses. ये एक चीज I have to just cover this up with the help of an example आएगा. Just give me another 5 to 10 minutes. We have a question on actuarial gains or losses due to remeasurement. Okay, that also will come here. Ideally, your liability should build up constantly, like क्लोजिंग बैलेंस प्लस पैसेज ऑफ टाइम के लिए जो फाइनेंस कॉस्ट है you add that will be the next year's closing balance. Current service cost will be added, that will be the closing balance will become next year's opening plus interest cost on that plus current service cost. It should be a straightforward movement. If there is any actuarial remeasurement that happens, change in actuarial assumption, that is something which is not in my control. That will change the closing balance of your obligation. And because of that, what happens is you will end up with actuarial gains or losses or any change in the effect of asset ceiling. If any of these three conditions arise, they are known as remeasurements of the net defined benefit liability or asset. Always remember, return on plan assets or change in effect of asset ceiling is excluding the amount included in the net interest. Interest is already covered in the P&L. So interest dobara mat lo. This return on plan assets is over and above the interest. So all these three things, they will go into other comprehensive income. They will go into other comprehensive income. Why other comprehensive income without reclassification to P&L? Matlab from OCI, they directly move to reserves. Why is that so? Why it goes in OCI? Because typically these are items where as an employer, as a company, as an entity, I do not have control over this. Movement in fair value of assets. Will I have any control? Answer is no. It depends on market sentiments. Change in actuarial assumptions. They change demographics. They change your assets. They change your attrition rate. They change your mortality rates. Do I really have any control on this? Answer is no. And because I do not have any control over this, it does not go and sit in your P&L. It goes and sits in a non-reclassifiable OCI. Are we okay with this? Is it fine?
Yes.
Yes. Did you understand whatever we recognize in the P&L? Yes. All right. Fine. This is same thing. They have expanded net interest on defined benefit liability or asset. ये पढ़ लेना. Okay. All right. Fine. Remeasurement of net defined benefit liability. Okay. This we will see with the help of an example. Okay. We'll see this with the help of an example. I'm moving forward to an example for you. Okay. All right. Then we can come back to that slide. Again, same question, same company, same facts, but only one thing is changing. Ratna pays a lump sum benefit equal to 1% of final salary for each year of service. Okay? The salary in year 1 is 1 crore, assumed to increase at 7% per annum. Discount rate is 10%. Show the build up till year 5. This is the same question that we have done. Okay? No change in this. In the second year, based on employees' performance, Ratna Limited expects the last drawn salary to be 1.5 crores. What will be the impact of this change? What will be the impact of this change? Okay, fine. Now see, what is changing here? What is changing here? Bolo,
Salary.
salary. Is it salary which is changing or is it expectation which is changing?
Yeah, expectation. Last the
Yes.
salary.
So, is this something which is within the control of the entity or is this something which is not within the control of the entity? Think and answer. Based on performance, the company expects last drawn salary to be 1.5 crore. पहले क्या सोचा था? It would be 1 crore, 7% increase. But now they are thinking it will be 1.5. What does that mean? That means employees performing very well because see 1 crore 7% end of 5 years it would be some 1.31 crores, but now they are saying they expect it to be 1.5 crores. That means what? Two three things can happen. Inflation rate is moving very high, so your increments should be beyond 7%, or employee is doing very well. In this case they have given that, so employees market value will be 1.5 crore at the end of 5 years. So is this estimate of his salary a company controlled figure or is it a market controlled figure?
Market control figure.
Market control. So can I say that I am changing a fundamental assumption in this particular case? The 7% increase is what I am changing, right? So can I say it is a change in a fundamental assumption? Yes.
Yes.
Well, Tell me. Yes, it is a change in assumption. Okay, it is a change in assumption. It is in fact a change in actuarial assumption. आपको अगर डाउट है, if you have doubt, I will show you something. Actuarial assumptions. We covered this in the last class. They are of two types: demographic assumptions, financial assumptions. Look at the second line: future salary and benefit levels. This becomes a financial assumption, which is in turn an actuarial assumption. Yes? Did you follow?
Yes.
Yes or no?
Yes. Yes.
Yes?
Yes, sir.
So, what am I doing in this particular question? I am actually undertaking an actuarial modification, assumption to your actuarial benefit. Okay. So now what we will do is we will run through the question. See, this part everybody would have understood. 6,55,000. The build up also we would all have understood. Now, in year two, they estimate the salary to be 1.5 crores. They estimate the salary to be 1.5 crores. When it is 1.5 crores, the cost of benefit on termination will be 1.5 crores into 1% into 5 years. It will be 7 lakh 50. How much it was earlier? 6 lakh 55. How much it will now be? 7 lakh 50. Is there a change in the ultimate cost of benefit? Answer is yes. About 1 lakh, your cost of benefit has gone up. So if I look at attribution, every month, every year, it will be 1 lakh 50. So I allocate, or I do the measurement on an annual basis. So 1,02,450 to 2,25,394. This is how the obligation builds up. So in year two, your obligation of 2,25,394 will be compared with 1,96,964. Under the old assumption, the value was 196,964. Now it is 2,25,000. So your obligation at the end of year two has increased by 28,430. Are you able to follow? Leela, Ayush, Bibhu, Sagar, Sanjay, all clear?
Yes, sir,
Yes,
clear.
understood.
Yes. But
Yes.
the thing is now, this modification is because of change in a financial assumption. This is not typically within the control of the company. This is just a change in assumption. And therefore, where should this item go? This item is an actuarial loss. Why loss? Your obligation has increased compared to what it should have been. So it is a loss. And where will this go? This will obviously go and sit in your other comprehensive income. So year one, old policy. Year two, old pattern, but I will do a catch up of 28,430. Okay. So credit liabilities 135,865. Are we able to follow? Yes. Year three onwards, the new plan will continue. Yes, new plan will continue. Any doubts here? Yes, no, not clear, fully clear. What do you think? Clear. Okay. What about Ayush?
Yes, sir. Clear.
Clear. Sanjay, Sagar,
Clear.
Vibhu, all
Yes,
clear?
clear.
Okay. So now we come back to our presentation. See, remeasurement of net defined benefit liability or asset. Determine current service cost using actuarial assumption at the start of the annual reporting period. Did I do this? Yes, मैंने यही किया था. 98,480 at the start of year 2, I did it based on current assumptions. Correct? Yes or no? मैंने 98,482 लिया current service cost. Yes or no? Yes. Then net defined benefit liability or asset is remeasured as per para 99. ये remeasurement as per para 99 is exactly what I have done in this case. I did a remeasurement. I measured the closing obligation as per the new plan. I compared it with the closing obligation as per the plan prior to the change in assumption. That gap, that catch-up adjustment is worth 28,430. And going forward, determine current service cost for remainder of the annual reporting period. Here I did it at the end of the period. If you had to do it in between, then for the remaining period in the year, you would do it based on the new assumption. But here I did it at the end. So therefore, the remaining tenure, the remaining years, I have done it based on the new estimate. Okay. Determine current service cost for remaining of the period using actuarial assumptions used to remeasure net defined liability or asset as per 99B. Are you able to understand this now? Yes. Did you understand this theory? Bolo.
Yes, yes.
This is
Understood.
Yes,
exactly
sir.
in line with the question that we have done. Only thing is my question, we have handled it over a 5-year period. Okay. Question 13, discussed. You can measure. Again, this is just theory. Nobody will ask you this. They will ask you the question that follows this concept. Okay. All right. Para 99 is explained here. Okay. Whatever it is. It is exactly what we have done. Okay. All right. What do you mean by return on plan assets? Whatever interest, dividends, other income you derive, plus realized, unrealized gains or losses, minus cost of managing the plan assets on and any tax payable by the plan itself. This becomes your return on plan assets. Basically, the final profit figure minus cost of managing plan assets minus tax payable. You will not deduct other administrative costs. You will not deduct other administrative costs. Okay. So with that, I think we are able to fairly be comfortable with what we have discussed so far. Anybody has any doubts? Till now, any doubts, anyone? Bolo? Ayush?
No, sir.
All clear. Bibhu?
Yes, sir.
Sagar? Clear? Okay. Sanjay, ठीक है?
Yeah, clear.
Okay, perfect. Thanks, Leela. Yeah. All right. Now, let us move on. See, these are not directly related to study module. मतलब figures match नहीं होते, but concepts are similar. So I have mentioned this is similar to illustration 24 on the new module. Okay. Illustration 24 अगर हम open करके दिखाएंगे आपको, तो see. This is illustration 24. This is our question that we are now going to do. Okay. See, company, present value, everything is the same. Obligation, fair value, format is exactly the same. Only figures have changed. So my suggestion, we will go through this question. You will do the ICAI illustration by yourself. You will do this part for homework. Concept I have explained. Similar question I'm doing. You should not have any problem in doing this particular illustration. Okay. So now, Bharat Power is a company with turnover 27,500 crores having a large employee base. The company has provided a defined benefit plan to its employees. Following information pertains to the balances of the fund's assets and liabilities for financial year 1920. Present value of the obligation you are given opening closing. Fair value of plan assets you are given opening closing. For financial year 1920, service cost was 1.65 crores. Company made a contribution of 3.33 crores. No benefits were paid during the year. Consider a discount rate of 8%. Compute the balance to be included in the balance sheet and amounts to be recognized in the P&L and OCI for 1920, as well as give a journal entry in respect of amounts to be recognized. Perfect. So we can do this? Yes? Fine. First one, see, either you can do in a statement form or you can do in an account form. I am more comfortable in an account form, but I have given both to you. Okay? Okay. So first one, we start with plan assets. Plan assets, what is your opening value? 3,420. So opening value 3,420. Closing balance 3,825, 3,825. No benefits were paid during the year. So benefits paid is 0. You should not write anything, but I have just put it in the template so that you can see it is 0. Contribution during the period 3.33. This is money which goes into the plan assets. So 333 lakhs. Okay. And when you do this, what you get is a balancing figure of 72. This is your actual return. This return includes interest as well as any return if it is there above or below the interest. Are you clear till now? यहाँ तक समझ में आ गया?
Yes,
Yes.
clear. Yes.
ठीक है. Next, if I look at the defined obligation account, opening balance 4,200, closing balance 4,740. 4,200, 4,740. Now, current service cost 1.65 crores, so 165 lakhs. Okay. Current service cost increases the obligation. We have seen the entry. Current service cost account debit to provision for post-employment obligation or DBO. Next, they have given discount rate of 8%. They have given discount rate of 8%. So this will be obviously your interest cost, 4,200 into 8%. Any doubts here? Any doubts here? 336. So when you balance this out, you are going to get a balancing figure of 39. This is your actuarial loss. Why this loss has arisen, I do not know. This could be due to change in actuarial assumptions. This is what they will ask. So being increase in DBO due to change in actuarial assumptions. Any doubts so far? Any doubts? No doubts? All clear? Yes? All clear? Ayush, Vibhu, Sagar, Sanjay, hope all is clear. Okay, Ayush has confirmed. Okay, fine. Next. See, now if you look at these assets, total return is 72. This 72 comprises of two things. One is interest and one is other return. Okay, so your interest will be opening balance 3,420 multiplied by 8%, this discount rate. Sir, why are you taking discount rate? Why not any other rate? Yes, so this comes to 274 or 274. minus 202. See, now if you come to the theory, somewhere it was there, interest. Okay, see here you can see net interest on net defined benefit liability is calculated based on the discount rate itself, which is the rates which we have already seen. Okay, so net interest is equal to opening balance of net defined liability multiplied by discount rate. What is your net defined benefit liability? This is nothing but liability minus assets. So on liability, when you apply the discount rate as an interest, on asset also you will apply the same discount rate. Okay, so that is why we are taking the same rates which are mentioned. Okay, so that is why we are using the discount rate. So now if we come to this question, 72 is your actual return. Out of 72, it means 274 you got interest, but you have lost 202 lakh rupees on account of actuarial changes. On account of actuarial changes. This is your other return. So when we come to your items to be recognized in the financial statements, I will recognize opening net liability. Oh, okay. Opening net liability will be how much? 3,420 assets, 4,200 liability. So 4,200 minus 3,420. So that gives you opening DBO 780. Net interest expense, you can take it as 336 minus 274. 336 minus 274. So 336 minus 274 gives you 62, or on 780 directly you can take into 8%. That also gives you 62. Closing net liability 4,740 liability, 3,825 assets. So that gives you 915 in the balance sheet. Increase in liability that has happened is 915 minus 780, 135. Okay. Remeasurement, that is on the plan assets, we have already calculated 202. Total remeasurement that is there is on assets 202 and on liability 39. So total is 241. What is the journal entry that we will be running through? P&L account, current service cost 165 plus interest expense 62, debit 227. Other comprehensive income, this is 241. To cash, this is the contribution that you make to the fund. To net defined benefit liability, this is your increase in the liability 135. That gives you your journal entry. In the P&L, service cost of 165, net interest of 62, OCI remeasurement of 241. And in the balance sheet, closing net liability of 950. Are we okay with this? Are we okay with this? Ayush, Leela, any doubts? Too many things at one time?
Yes,
Yes.
too many
Yes, sir.
things.
So not clear. Ayush, go ahead.
Sir, we are just digesting it.
जल्दी जल्दी करो, क्योंकि इससे बड़ा क्वेश्चन एक और आने वाला है, राइट? You will have a bigger question on than this. What you generally have to see is, see, in your the way the institute has solved, you can do it this way also. Okay. You can go on a net basis or you can do on a gross basis. I will prefer gross basis. Matlab benefit obligation you do separate, plan assets you do separate, and then you club both of them manually. उससे क्या होता है थोड़ा सा you will take little bit of extra time, but you will not get confused. The moment you club both of them and try to make a single T form account, initially it will create confusion. I just want you guys to avoid that confusion. Okay. All right.
So we bifurcated this 72 in plan assets account, the balancing figure.
Yes.
3420 into 8%, 274. The balance 202 is the balancing figure, I think.
Yes. 274 minus 202 gives you 72. So this is a balancing figure.
Balancing figure 202. Okay.
Yes. 72 is a balancing figure from this account. Out of 72, 274 is coming from interest. So you are actually losing on other returns. Okay?
Yes, right.
That's right.
So we can also write interest in that plan asset account, like
आप लिख
274.
सकते हो, no problem. What you could do is you could write here to interest and here you could write by actuarial loss. Perfectly fine. No problem. Okay.
Yes, sir.
So Ayush is saying we will write to interest 274 here, which is okay. In which case you will have by actuarial loss 202 on the credit side as a balancing figure. That is also fine. All right.
Yes, sir.
विभू समझ में आ गया? सागर, लीला, clear बेटा? All right. She has understood. Yes. Shall we proceed? I do not want to give a break right now. You will have to wait for 20-25 minutes because we are on the cusp of closing the chapter. Okay. This is the biggest part. Like once I do this, once you have understood this, you are effectively through with 95% of the chapter. Shall we proceed? Yes. बोलो आयुष.
Yes, sir.
You need some more time, Sanjay?
No, we can proceed. I was going through the solution.
Okay.
That's why
Okay.
yeah.
You're stuck somewhere?
No. I'm trying
No?
to understand completely. Yes.
I can give you 5 minutes to just run through this solution. That much I can give. Okay. So take your time. आप 2-3 मिनट देखो. If you have any doubts, please revert. I'll not hurry up because the next question what we will do is a fairly bigger question. Okay. Did we understand? Yes, Sanjay, Bibu. आयुष ठीक है? Can I proceed? Go
Yes,
ahead.
sir. Okay.
You're not audible. Am I audible?
Yes, you are audible. Yes, we can proceed now.
We can proceed. Are
Yes.
you comfortable? Leela, are you okay, beta? Bibu?
Okay, sir.
Okay, fine. ठीक है. So this is a typical examination question that you can expect. Okay. This is somewhat similar to what you can expect in your questions on Ind AS 90. Okay. All right. So recognition in P&L, this is done. Remeasurements to OCI also we have done. Okay. Fluctuation of turnover, retirement, salary increase, or change in future turnover, change in discount rates. What is your return on plan assets? Total return minus net interest. We have seen that 202 in our case. Change in effect of asset ceiling, will come to this later, but we have seen the effect already. We saw this question. All right. ठीक है. This is an old question. It was there in the earlier module. That is why I have written to remove, but question is correct. Okay. What I will do is I will run you through one of the questions, which is a very nice question. Okay. You can do this for homework. This is the same question. Statement form में दिया है. Fair value of assets opening 20 lakh 40 and obligation 21 lakh 25. Year end plan received contributions of 4 lakh 75, paid out benefits of 2 lakh 65. Current service cost is given, interest rate 5%, closing fair value is given. Prepare a reconciliation from opening to the closing for the plan assets and defined benefit obligation. How much should be in the P&L, how much in OCI, how much in balance sheet. Is it different from what you have done? Is it different from what you have done?
No, it seems same.
एग्जैक्टली सेम, खाली वो
Yes.
टेबल नहीं है, स्टेटमेंट दिया है. टेबल आप बनाओ, you can just go on doing it easily. You will pocket 7 marks in your number. यहाँ पे तो question also has given closing balance. So what you have to do, you just have to give the figures. मतलब it is like they are all pieces of a jigsaw puzzle. और फिर match the following type. कहीं पे पड़े हैं, you just have to reallocate and give it to your examiner. हो गया. So this is a 7-mark question straight away into your pocket. Okay. Now we come to the most important question of this section. Okay. Once you do this and you get it, then I think I don't have to explain any other concept in this particular chapter. Okay. As far as this post-employment obligation is concerned. Okay. So what we will do is, the solution is also there. Okay. So we will go on tabulating the question along with the solution. Okay. So now Arunachalam operates a defined retirement benefits plan for current as well as former employees. Given the large size, it engaged a firm of actuaries for advice on the contribution levels and overall liabilities of the plan to pay the benefits. The following details are presented. On 1st April 2019, actuarial valuation of the present value of the obligation was 15 crores. On the same day, the fair value of the assets was 13 crores. So, can you see this? Opening balance of obligation 15 crores. Opening value of asset 13 crores. Are we okay together with each other now? Yes? Sure? Don't look at others. I'll just go on tabulating the data. तो इससे आपको समझ में आएगा that I'm not doing anything extra. ठीक है? Next. On 1st April 2019, the annual market yield on the bonds was 5%. The annual market yield on the bonds was 5%. That means what? What does that mean? This is nothing but your interest rate. This is nothing but your interest rate. Yes or no? Bolo.
Yes, sir.
Yes, yes.
Yes. So, on opening balance, your interest will be 15 into 5%, so 0.75 crores. Correct? This is your interest cost. And on the benefit, 13 into 5%, 0.65 crores. Any doubts here? Any doubts?
No doubt,
No,
no doubt.
sir.
Doubts? बस तो इसका इफेक्ट दे दें अभी. So interest cost is a credit in the obligation. It increases your obligation. Whereas interest income is a debit in your assets. It increases the value of the assets. So 75 lakhs and 65 lakhs we have already taken. We have already taken. All right. So this adjustment is done. Next. During the year ended 31st March 2020, Arunachalam made contributions of 1.75 crores into the plan, and the plan paid out 1.05 crores to retired members. Assume that both these payments were made on 31st March 2020. Acha, 1.75 crores, where it will go? Bolo.
Into plan assets.
Into plan
It will
assets.
increase. Yeah, it will
It will
increase the
increase.
value.
Absolutely right. The plan paid out 1.05 crores. Where will this go?
Also
This
in
will
the
be
plan
reduced
assets,
from the plans.
plan
And
assets
obligation?
reduction. Obligation will also reduce by the same amount.
Yes, that is important. Both the sides it will go. Plan assets also will drop. Defined obligation also will drop. It is like you are paying the obligation but getting reimbursed by the plan. Technically ऐसे होता नहीं है. The trust itself pays the amount to the employees directly. Okay. Technically that is the way it is handled. So, but the key point is even the obligation goes down and the assets go down. So we shall just record both of them. Contributions paid into the plan 1.75 crore debit. Debit, plan assets debit to contributions paid, that is cash bank. And benefits paid is credit to this and it will be a debit to this. Are we all convinced about this? Leela, are you convinced? Yes?
Yes, sir. Okay.
Okay, fine. So no doubts till now. So this entry also is done. The current service cost for the year was estimated at 1.55 crores. What will happen with current service cost? It will, obligation पे क्या effect होगा? What will be the effect on the obligation?
It will increase the obligation.
It will increase because employee has worked for the full year. He gets entitled to the obligation. So entry will be current service cost, which is a P&L item, credit the obligation. So we will be having current service cost, credit obligation, 1.55 crores. So this is done. So far, any doubts? I haven't done anything. I'm just putting the data in the appropriate places. Okay. On 28th February, the rules of the plan were amended with retrospective effect, which led to an increase in the present value of the obligation by 37.5 lakhs. What is this? What is this?
it have an effect with the previous year's figure changes also.
सोच के बोलो. Rules of the plan were
Past service cost.
yes. This is हमने question किया ना. 1% became 2.5%. We did it today only, right?
Yes, yes.
Yes, sir.
Which gave an increase of some 2 lakh change rupees in that example. Yes or no?
Yes, sir.
सब कुछ शॉर्ट टर्म मेमोरी लॉस होता है यहाँ पे. यस, आज ही किया है यार. वी स्पेंड लॉट ऑफ टाइम. ओके, आई विल शो यू.
Yes, we remember it clearly.
यू रिमेंबर इट. 2,95,000 पास्ट सर्विस कॉस्ट. क्या हुआ था? 1% टू 2.5. सेम थिंग दिस इज. ओके, बस इसमें क्या किया है, इसमें थोड़ा सा इंग्लिश डाल दिया है. राइट. द प्लान वॉज अमेंडेड विथ रेट्रोस्पेक्टिव. दिस विल कंफ्यूज यू. With retrospective effect, ठीक है, that will hit my current year cost directly, which led to an increase of 37.5 lakh. So past service cost is an expense. It will hit the P&L debit and it is increasing the obligation. So credit defined benefit obligation. So past service cost 37.5 lakhs. A, B, C done. Question looks big, but when we are going on putting the data, it does not look big. Till now, everything is clear? Yes? तो आगे बढ़ते हैं. During the year ended 31st March 2020, Arunachalam was in negotiation with employee representatives regarding planned redundancies. Redundancies matlab they are retrenching the employees. Okay? These negotiations were completed shortly before the year end and the redundancy packages were agreed to. The impact of these redundancies was to reduce the present value of the obligation by 2 crores. Okay. So they are reducing the obligation by 2 crores. Before 31st March 2020, Arunachalam made payments of 1.875 crores to the employees affected by the redundancies in compensation for a curtailment of their benefits. Okay. So what is happening? This part is new. This part is new. Tell me one thing. See, during the year, Arunachalam was in negotiation for redundancies. They came to an agreement. Impact of these redundancies was to reduce the present value of the obligation by 2 crores. That means what has happened? I am redundancies मतलब क्या हो रहा है? Number of employees reduce. When number of employees reduce, can I say that the number of people who will get benefited by the plan will reduce? Can I say that? Yes. If I'm laying off employees, I have an employee benefit plan. If I'm laying off some employees, it means the number of employees who will be beneficiaries of this plan will reduce. Yes or no? Bolo yaar.
Yes,
Yes, sir.
yes,
Yes. That means, can I say that their benefits are curtailed? Yes.
yes, yes,
Curtailed. Curtailment का मतलब क्या? आप उनसे उनका बेनिफिट छीन रहे हो. We saw in the case of cancellation of ESOPs. For cancellation, we have to compensate them. Similarly, here also, because I am curtailing their benefits, I have to pay something. Yes or no? Tell me.
Yes.
Yes, sir.
Yes, I have to pay them something. So what is happening in effect is, just understand now. I am having a payout of 1.875 crores. I'm paying this much today so that their benefits worth 2 crores get curtailed. Their benefits worth 2 crores get curtailed. Are you able to follow this? That is what
Yes.
they are saying, right? Arunachalam made payments of 1.875 crores. And with this payment, the obligation reduced by 2 crores. समझ में आ गया? Yes. So basically, the company is in a beneficial position. An obligation of 2 crores went away with just 1.875 crores worth of payment. So 2 minus 1.875, company को 12.5 lakh का फायदा हुआ. Company is benefited by 12,50,000 rupees. Any doubts so far? Any doubts?
Clear. Yeah, no doubt. Clear.
All clear. So now let us look at the posting. Let us look at the posting. See, company is paying 1 crore 87 lakh 50. Company will not pay this directly to the employees. एक बात याद रखो, generally companies will prefer to settle this through the trust. So by curtailment and settlement, this is a P&L account. Okay, it will hit. 1 minute. 1 minute. Yes. So again, payout is happening from plan assets. So 1 crore 87 lakh 50, your plan assets will drop. So entry will be curtailment. I reduced the number of employees and I'm settling them. 1 crore 87 lakh 50,000 to plan assets. 1 crore 87 lakh 50,000. And by virtue of this payout, what is happening? This won't be gain on settlement. My obligation is reducing by 2 crores. My obligation is reducing by 2 crores. Yes or no? Correct?
Yes. Yes. Correct.
So this is curtailment and settlement. So what happens is defined benefit obligation debit 2 crores to curtailment and settlement 2 crores. Any doubts? Ayush, Leela, Bibhu, समझ में आ गया? Yes?
Yes, sir.
Yes, sir.
All right. So in effect, the curtailment and settlement activity has given the company a benefit of 12 lakh 50,000. Has given the company a benefit of 12 lakh 50,000. We call it as a gain on settlement. ठीक है? So that takes care of this paragraph. Okay? पूछ रहे थे ना curtailment settlement क्या होता है? यही होता है. Okay, this is what happens. Money will go from the plan also. Obligation also gets reduced. Typically, it won't be same. The difference between the obligation value that is reduced and the payout that happens is what hits your P&L. Okay.
Okay,
On
sir.
31st March 2020, the present value of DBO was 17 crores and the DBP assets was 14 crores. So closing balance is 17 crores. Here closing balance is 14 crores. So this is your balancing figure. What is your balancing figure? This one. Actuarial loss, and here there is an actuarial gain. Are we okay with this? Hello?
Yes. Yes. Okay. Yeah.
Yes?
Completely. Yes.
Completely okay? All right.
Yes.
Ayush?
Yes, sir.
ठीक है. Good. Now, blue color. All right. Now, interest income, P&L, curtailment settlement, P&L, interest expense, P&L, curtailment and settlement, P&L, past service cost, P&L, current service cost, P&L. These are where all the items will go. So current service cost 1.55 crores. ठीक नहीं लग रहा है. Okay. 1.55 crores. Interest cost 75 lakhs. Here 65 lakhs income. Past service cost 37 lakh 50. Gain on settlement 12 lakh 50,000. Have you understood this? Yes. Yes. Bolo. Tell me. Yes or no?
Yes, yes.
So this is your balancing figure. Net employee benefit expenses 1.9 crores. वो income में चला गया, वो income नहीं है. This is your net expense. Okay. Net expense. When we were just typing the solution, we had done it in a columnar form, तो just वो वहां पे रख दिया है बस. But it is an expense. Okay. All right. Other comprehensive income. What will come? 2.375 crores. And gain on plan assets 1.525 crores gain. So net expense or net actuarial losses 85 lakhs. ठीक है? Yes or no? Tell me. Did you follow? Ayush, Sanjay, Leela, Vibhu, did we follow this?
Yes, sir.
Yes.
Yes, sir.
All right. Cash bank net impact 1.875 crores we have removed from the plan assets. 1 second. Okay, this would be the overall picture. Okay. Mm. Yeah, not overall, just this one. Contribution to the plan. Cash bank. Did you follow this? Because company is paying only 1.75 crore. Remaining all movements are happening between the plan assets and the defined benefit obligation. There is no cash flow involved in that. ठीक है? Yes. अब
Yes,
आगे
sir.
बढ़ते हैं. Yes. Now, how will the actual presentation happen? This is the whole account prepared in statement form. Defined benefit obligation, and this is plan assets. Statement form. Please देखो, it is nothing different from what we have done. Net amount in the financial position statement, that is the balance sheet. Opening value of obligation, opening value of assets, net liability of 2 lakhs. Closing value of 2 crores, sorry. Closing value of obligation 17, closing value of assets 14, net obligation of 3 crores. Net obligation of 3 crores. Amounts that come in the P&L, current service cost, past service cost, gain on settlement, interest on defined benefit obligation, interest income on plan assets. So 1.9 crores is your total that hits the P&L. And total comprehensive income 85 lakh is your remeasurement. Are we okay with this? Yes. Are we okay with this? Polo?
Yes. Yes. Yes.
So with that, the question is over. And with that, your post-employment obligation is also complete. There is nothing else that is left in this now. Okay. The remaining two, that is termination benefits and long-term service benefits, both chote 5 minutes, we can complete both of them. Have you understood this part? Yes.
Yes, sir.
Any doubts in this question? It is a very, very wholesome summary question. Okay. Please go through this. This one question should be able to satisfy everything as far as post-employment obligations are concerned. Okay. All right. We take a break. It's 9:10. We shall convene at 9:15. Just a 5 minute break I'm giving. I still have a substantial thing to do in terms of getting some question on that plan as asset ceiling and that ESOPs. More than asset ceiling, I think I want to cover that ESOP thing also. That is also a priority for me. So take a quick 5 minute break. We shall resume at 9:15. Is it okay?
Yes,
Yes.
okay.
Yes,
Take
sir.
a 5 minute break. Yeah. 5 minutes break, please. that takes care of your plan assets, post-employment obligations. So there is one small thing, right to reimbursement. Sometimes what happens, you get to be reimbursed for whatever is the obligation. So recognize an asset of reimbursement only when virtually certain that another party will reimburse the expenditure. Otherwise, do not recognize. Treat it as a separate asset. Do not net off. Disaggregate and recognize changes in fair value, same as change in fair value of plan assets. Insurance policies, if it is a qualifying insurance policy, do not treat it as a reimbursement, right? It will be part of your plan assets. But if it is not a qualifying insurance policy, then it will be treated as a reimbursement, right? And carry it as a separate asset. Okay, so these are the disclosures. You can just go through this for homework. Okay, these are specific disclosures. Okay, now other long-term benefits. See, we covered short-term benefits, we covered post-employment, other long-term benefits. Service award. Somebody has served for 10 years, 15 years, 20 years. They get some benefit. They get some cash reward or something for their loyalty. So these include jubilee or long-term service benefits, sometimes long-term paid absences, long-term disability benefits, profit sharing or deferred remuneration, even leave encashment. If you have people who are working in public sector undertakings in your family, particularly you can say somebody like my parents or that generation, okay, the generation who joined the banking sector or telecommunication sector somewhere in 1970s and 1980s, who have retired, okay, those types. Okay, now these people would have something known as leave encashment. They would go on accumulating leaves, and they are supposed to retire on say X date. They would have a leave balance of 6 months. So 6 months before only they would retire off. They would retire. Okay, notionally retirement ho jata tha unka. They would exhaust the 6 months of leave. They would get fully compensated for that. And on just the day before retirement, they would go greet all their colleagues and say that from tomorrow I am retiring. And then on the day of retirement, they come with the retirement checks in hand. Now, this leave of 6 months, which they have accumulated, this is a long-term paid absence. This is not a short-term paid absences like what we saw. Short-term paid absences within 1 year, you have to utilize or it will be carried forward and then it gets lapsed. This is a long-term paid absence. That long-term paid absence gets covered here. Okay. So the benefit, again, you will have to measure the obligation based on the probability that payment is required and the length of time for which payment is expected to be made. Something like what we have already seen in post-employment benefits. Okay. Kitne benefit? Will the employee be there? Will he be stable? Will he continue? Will he leave? What will be his salary? All those estimates will come here also. You will again calculate a deficit or surplus. Same thing. You will again calculate a reimbursement, right? If it is there. Same thing. Only thing is you will recognize everything in the P&L. Nothing will go in OCI. That means service cost will go in the P&L. Net interest on the benefit liability or asset will go in the P&L. Remeasurement of the net defined benefit liability or asset, this also will go in the P&L. The difference, this remeasurement in post-employment benefits, where would it go? Where would this section go there? Come on.
P&L?
This would go there in other comprehensive
There,
income.
yes, there
It
it would
would
go
in
to
OCI.
OCI.
Here, this goes in the P&L. Okay. This will not hit the OCI. So other long-term employee benefits, everything will go into the P&L. There is some component that goes to the other comprehensive income. Okay. So I leave this question to you for homework. It's a very small question. We have done the biggest complicated question. So I think you will not have any problem in doing this question. Okay. Next we have, so that is other long-term benefits. And then we have termination benefits. Here, the obligating event is not employee giving services. Obligating event is employee getting terminated. So the termination is your obligating event, not service provision. So this will not crystallize when employee is serving. This will crystallize when employer has terminated, when termination is given. So when do I recognize? So event giving rise is termination instead of employee services. Employee benefits payable as a result of employee's decision to accept offer of benefits in exchange of termination. That means he is happy with the severance package and he will go. Entity's decision to terminate employment before the normal retirement date, layoff. So when do I recognize? At what point of time? Earlier of the date when the entity can no longer withdraw the benefits, or the date when the entity recognizes cost for restructuring, which involves payment of termination benefits. And what earlier of these two dates? When it can no longer withdraw or when it can recognize the cost of restructuring. Earlier of these two dates, it goes into the P&L. When can the entity no longer withdraw? If the employee's decision of accepting the offer or restriction to withdraw the offer, later of these two, or entity's decision. Significant changes unlikely, number of employees identified, termination benefits established in the plan. Okay. So plain simple accounting. Okay. Measurement, if it is it depends on the nature of benefit. Enhancement to post-employment benefits, it goes as post-employment benefits. Expected to be settled within 12 months as short-term employee benefits, not wholly settled within 12 months as other long-term employee benefits. So pretty straightforward accounting. Okay. All right. Next, you can go through this particular example for your understanding. After assessing the impact of COVID-19 pandemic, which affected the operation since Jan 2020, Enjoy Travel Limited decided to shut down one of its divisions towards the end of 1920 and published a formal plan of closure with redundancies of employees and termination of the employment. The plan details as follows. Expects commencement of closure in 2021 and completing the full closure by the end of 21-22. Okay. Enjoy Travel offers to pay 13,50,000 to each employee leaving the company before the closure. As Enjoy Travel needs qualified employees to perform the closure, total benefit of 22,50,000 promised to all employees staying in the company till the closure is completed. Total number of employees affected by the closure is 400. Enjoy Travel assumes that 100 of them leaves before the closure and 300 stays until the closure. How should Enjoy Travel recognize and measure termination benefits at 31st March 2020 and 2021? Applicable discount rate is 5%. We can go through this one question for you. See what happens. Those who stay, they are getting 22,50,000, correct? Till the closure happens. Those who leave, they are getting 13,50,000 immediately. That means 9 lakh is given for the employees to perform the services. This is services, this is termination. Are you able to follow? Yes. Are you able to follow this?
Yes, sir.
Follow.
Yes, sir.
Yes. Yes, all right. So in exchange for termination, everybody gets terminated. So 400 employees into 13,50,000, 5,400 lakhs gets terminated. This is your termination benefit. Service benefit, 300 employees expected to stay until closure. So 300 into 9 lakhs, 2,700 lakhs. So total benefits, 8,100 lakhs. That is 81 crores. Are you okay with the first part? Are you?
Yes.
Yes. All
Yes.
right. Perfect. Now we move on to the next one. See, 100 employees are leaving immediately within this year. So for these 100 employees, payment will happen immediately. Yes. So 100 into 13 lakh 50, 1,350 lakhs, 13.5 crore payment will go immediately. Do you agree to this? Yes.
Yes.
These are the employees who will not stay for the closure. They will be leaving in this year itself. So no discounting. The remaining 300 payment will happen end of next year. So I will have to do a discounting. Discount rate is 8%. So 300 into 13 lakh 50,000 divided by 1.08. 37.5 crores is your present value of termination benefit that will be paid later. Yes? Are you able to follow this?
Yes. Yes.
Ayush, Leela?
Yes, sir.
Yes, sir.
Yes? All right. Now, in exchange of service, I am paying them 9 lakh rupees. That is 27 crores over 2 years. That means each year 13.5 crore I will be paying. I hope this also you would have understood. Okay. So now when I look at the attribution of this 2021, 21, 22, opening obligation 0, interest 0, 0.9259. So 13.5 into 0.9259, 1250. Same attribution table. So 27 crores at the end of the second year. This is how the obligation will be accounted for. So first thing, in 1920, what am I going to recognize? 5,100 will be your expenses to be booked. Employee benefits expenses to provision for termination benefits, 51 crores. This is after discounting. Out of 51 crore, how much I will pay immediately? 13.5. Provision for termination benefits debit to bank, 13.5. Then finance cost will come. Finance cost, that is basically employee benefit expense to provision, 300 lakhs or 3 crores. Balance of termination benefits, 40.5. Balance will be 40.5. Other long-term benefits is this 12.5, which I recognize. This is in exchange of service. So personnel expenses debit to other long-term benefits, 12.5. Any doubts so far?
No.
Any doubts? No doubts. So shall we proceed further? Yes. Next, I will be paying the termination benefits by end of the second year. So provision for termination benefits to cash, 40.5 crores. Termination benefits is closed. Other long-term benefits, I will take this 100 as a cost. So interest cost debit to provision for other long-term benefits, 1 crore. Personnel expenses, this is the second year's cost, and total 27 crore you will pay at the end of the second year, and that will close your other long-term benefits also. Have you understood this? Very simple question. Okay. Any doubts? Anyone here? Yes. Any doubts? Bolo. Does anybody have any doubts here? Clear. Okay. Ayush, all clear?
Yes, sir.
All right. Okay. So that covers termination benefits also. Okay. So go through this question. Similar hai. This is an example that is there. You can go through them for homework. Okay. Benefits provided in exchange. Okay. Then Appendix A to 19, Ind AS 19, that is accounting for contributions from employees or third parties. Okay. This you can just go through as homework. It is not having any practical question as such. What is minimum funding requirements for future contributions? What is how to account for contributions from employees or third parties? How do you account? You can just go through this for your understanding. Okay. What is the effect of minimum funding requirement on economic benefit available? Yes, sir, pad lo. This is only going to have a theoretical application. It does not have any practical question that is there. I am more interested in doing that small bit of ESOPs which was left over. So anyways, with this, I think we would be concluding Ind AS 19. Now, what was left is Ayush's question that what exactly do we mean by asset ceiling? Okay, so what I will do is I will just explain that with a small example. Suppose I have a total plan assets of, let us say, 10 crores. 10 crores. Okay, or let us make it 100 crores. Okay, I have plan assets of 100 crores. Now, this plan is being handled by some administrative team. They have their own team. They have their, what you can say, they have their salaries to be paid, admin cost to be incurred, etc., etc., etc. So I went on depositing money into the plan. Now, out of these, set aside for admin expenses, I will set aside 10 crores. I need at least 1 crore for my operation. So 10 crore pe 10% return, 1 crore has to be there with me at all times for my administrative expenses. Means this 10 crore can never be utilized for employee benefits. These 10 crore you cannot utilize. You cannot claim a refund also. आपने पैसे दिए, but you cannot get this money back. So your effective funding that you have given is 90 crores. Your effective funding that you have given is 90 crores. Now, your present value of defined benefit obligation. Let us suppose that this is 80 crores, or we'll make it 85 crores. So 90 minus 85, I have, or we'll make it 75 crores. Okay. I have a surplus of 15 crores. I have a surplus of 15 crores. Now, tell me one thing. In your balance sheet, mm, surplus of 15 crore, that is net defined benefit asset. Your net defined benefit asset is 15. Okay. But your usable surplus let us suppose, is only, yes, you have a book surplus of 25, total plan assets 100 minus 75 worth of defined benefit obligation. So you have a net surplus in book terms of 25 crores. But tell me one thing, Can I utilize this entire 25 crores for my employee benefits in the future? Answer is no. Because out of 25 crores, 10 crores never belongs to you. 10 crores will never belong to you. So therefore, the amount that is available to you to utilize as an asset is only 15 crores, is only 15 crores. And therefore, you will restrict your recognition of surplus to the extent of 15 crores. Kalko, you can pull out 15 crores from the plan. Technically, if you are winding up, if your employees leave, if everything is over, you can pull out only 15 crores, which is the balance available after settlement of all the monies to the employees out of the plan assets. The plan will continue to retain 10 crores. Okay, the plan will continue to retain 10 crores for whatever reasons, because plan is not going to be shut down. Plan is not shutting down. It's you, the entity, which is shutting down. So therefore, this 15 crores we are going to set aside as my usable surplus, and this is only what I can recognize in my books. I cannot recognize 25 crores. Is it okay, Ayush?
Yes, sir. Now understood.
Yes. So
Yes,
this
sir.
is
Thank you,
what
sir.
is your asset ceiling concept. Okay. Many times what happens, even this 15 crore may not be your surplus. What can happen is they will say, I still need under certain regulatory requirements another 5 crores. In which case, your usable surplus could even dip to even 10 crores. So you should be recognizing a net surplus of only 10. You cannot recognize 25 in your books. It's basically the amount which you are going to, which you will be able to use in the future, which you will be able to use in the future. Okay, so that is all about uh, employee benefits. Okay, so that kind of clarifies our position. Then last concept for the day, should not take much time, is your group SBPTs we had done. SBPTs. Okay. I think you remember these things a little bit, right? I hope you have not forgotten this. It's been just what, 15 days since I taught this chapter. Okay. 30th September and I think 1st October or 4th October we had a class. So exactly 2 weeks before. Okay. Now, last part of this, share-based payment transactions with cash alternatives. See, what happens is we have seen share-based payments where I have given the employee an option to acquire the shares. Okay, he can buy the shares if he wants, or it will lapse. Another case I saw where employee will get cash depending on the share price movement. So that was a stock appreciation, right? You remember these two things? Yes.
Yes, sir.
Yes.
Now there is a third instrument. Employee, if he wants, he can subscribe to equity, or in the same instrument, he can say, I don't want equity, I want cash. It depends on employee's option, employee's choice. So this is a combo offer of stock appreciation right as well as a stock option plan. It is a combo offer. SBPTs provides the counterparty with a choice of settlement. So what essentially is being given is a compound financial instrument. That means it has a debt component also, because the counterparty, the employee, can ask for cash, or the employee can ask for equity shares, in which case equity has to be there. Okay. So what happens is fair value of debt component is measured separately, and equity component is treated as a balancing figure. Equity component is treated as a balancing figure. The entity shall recognize goods or services acquired and a liability to pay. Okay, that is the cash. And shall recognize the goods or services received and an increase in equity. for the equity settled stock options. For the equity settled stock options. So this is what you have in terms of SBPTs with cash alternatives. Okay. All right. Now let us see directly. We come to the questions to see how exactly it pans out. To see how exactly it pans out. Okay. All right. So now, yes. See, understand this question. It's a little different than what you would have seen it. So just let us understand it carefully. Okay. On 1st January, ABC gives options to its key managerial personnel to take either a cash equivalent to 1000 shares or 1500 shares. So they have an option to take cash equal to 1000 shares or separately 1500 shares. So this is option 1. This is option 2. Okay. It's not cash equivalent of 1000 or 1500. They are two different options. An employee will come, acha, you will get cash equal to 1000 shares or I will give you 1500 shares. Obviously, shares will be more because that is not a cash element. Minimum service requirement is 2 years. This is your vesting condition. Shares being taken must be kept for 3 years. This is
Lock-in period.
shares with a lock-in period. Absolutely right. Shares with a lock-in period. Okay. Fair value of the shares are as follows. Share alternative fair value with restrictions 102. Grant date fair value. This is of a plain share 113. Fair value on December 20x1 120. Fair value on December 20x2 132. Employees exercise the cash option at the end of the second year. Pass the journal entries. Okay. So now you see, I am having an equity option of 1500 shares. Do you agree? Yes. Yes or no?
Yes.
What
Yes,
am
sir.
I what am I going to take the value of these equity shares? Should I take 102 or should I take 113? Tell me. Go ahead, Sanjay.
Fair value with restricted alternative fee.
Yes, you have given these shares to your employees. Those shares which you have given to your employees are with restrictions. So you cannot take the fair value. You will have to take the restrictive fair value. 1500 into 102, 1,53,000 rupees is what is the fair value of the equity alternative. Then I also have a cash equivalent which is given 1000 shares. On the grant date, the fair value is 130. So 1,13,000. So now think of it like this. It is as if I'm saying, look, employee, you have option to buy 1000 shares ka cash equivalent. Okay, you have an option to get cash equivalent to 1000 shares, or you can give this out. In return you can get equity shares worth 1500 with restricted usage, with lock-in period. So tell me one thing, is an employee here getting only one instrument or is he getting two instruments? Is he getting two instruments? What do you think? What do you think? Is he getting one or is he getting two? Think. What is the employee getting? He is getting one plan. That plan offers him two options. He can either go for cash or he can go for equity at the end. At the end. That means what? Let us suppose Ayush is there. Ayush is working for one company where they give him a stock appreciation, right? Worth 113. Okay. Sanjay is working for another company which gives him a stock appreciation right of 113 on same conditions as Ayush, but Sanjay is also given an alternative to surrender the cash and in its place get equity. So tell me one thing. Is Sanjay getting something more valuable than Ayush or something less valuable than Ayush or same as what Ayush is getting? Hello? Hello?
Yes, sir.
What? Yes. Sanjay is getting something more valuable because he is not only getting cash, but he's also getting an option along with that cash that आगे चल के in the future you can ask for equity. Yes, Ayush के पास कोई option नहीं है. Ayush has to take only cash. So now what the standard says is you have to recognize that excess amount. You have to recognize that excess thing which you are getting in your financials. So what is the mechanism? The mechanism is you look at the equity alternative which you are given, which has the restricted transfer period. The fair value of that is 1,53,000. Cash alternative value is 1,13. This is what Ayush has gotten normally. This is what, in our example, Ayush has received. Sanjay is getting something extra. That something extra is equity alternative minus cash alternative and equity option of 40,000. So if I look at Sanjay, Sanjay is having a cash option on the grant date of 1,13,000 plus an equity option whose fair value is 40,000. In future, he can either get cash or equity. Fair enough. But aaj ke tarikh mein, he has this option. So he is having something which is more valuable than what Ayush has, which is why you will have to recognize your value accordingly. So now this is how the equity option should start getting recognized. First thing. Now let us move on to spreading it over the service period. What is the vesting period? 2 years.
2 years.
Yes. So how many options are given? 1,000 options. Fair value of that option 120 at the end of the year. So 1,20,000 divided by 2, 60,000. The fair value of equity option is 40,000. I will be spreading it equally over 2 years. I will be spreading this equally over 2 years. Next, 1,000 options, end of second year, 132 minus what is recognized earlier. So current year expense will be 72,000. What the standard tells is, look, Sanjay is having an option for cash or equity. So treat this instrument as a stock appreciation right with an equity option. Treat it as a stock appreciation right with an equity option because in future, if Sanjay says, I don't want equity, I want cash, the liability should be there in the books to recognize the demand for cash from the company. So treat it as a SAR. So we'll do the accounting as a SAR, but we will also recognize an equity option. So in this case, I will recognize an SBP liability, SBP liability of 60,000 and an SBP reserve of 20,000. So total is 80,000. This 20,000 again next year it will come again because this is apportioned over 2 years. 72,000 is the second year cost. So total expense for year 2 is 92,000. Next, when you are subscribing for the cash option, employees exercise the cash option, entry will be SBP liability account debit to bank account 1,32,000. Then what will remain of this SBP reserve 20 plus 20 40? We will move that to retender needs. We will move that to retender needs. Are you able to understand this? Yes. Have you understood this part?
Yes.
Ayush, Leela?
Yes, sir.
Yes.
Yes,
Yes.
sir.
Okay. Vibhu? All right. Fine. Similarly, we have the next question. A very similar question. Okay. Only thing is instead of 1 year, instead of 2 year vesting, this is for a 3 year vesting. So this one question, you can try these 2, 3 questions as homework. Okay. That alone is enough for your understanding. Questions same hai. There is no difference. Only thing is your time period changes from 2 years to 3 years. Okay. So this was the one small part that was left to be covered in employee stock option plans. Okay. Okay. Anything else that you have any doubts in employee benefits or in ESOPs? Please let me know. Okay. Any other doubts in today's class? Yes. Ayush, Bibhu, Sanjay, Leela, any doubts? Anything you want more explanation or clarity on? Yes. Yeah, Ayush, tell me.
No, no, sir. It's clear actually. So
It's
nice
clear?
only.
Acha, theek hai. Any suggestions? You want anything else from me? Am I too fast, too slow?
It's at the pace, sir.
सब ठीक है? Okay,
Sir.
ठीक है. Sanjay, anything you want from my side?
It's okay. Just going through question 12 again. I will go through again. If there will be any question, I will maybe
Yes,
ask in
I
the next one.
think you should be able to reach out without any hesitation. There is one institute's email ID where you can reach out to me also immediately. I'll have to check that ID where it is. ठीक है. ठीक है. Let me check. Just a minute. Just give me a minute. Okay, sorry. I think if there is anything, please let me know. Otherwise, we can wind up the session. Okay. Please keep your access to the study portal because I'll be putting in some questions for practice, which includes theory as well as numericals in MCQ form. So you can try it out for your own speed and understanding. Okay. Otherwise, I think you have access to all the material, whatever we have shared in the last 4 classes, right? Yes.
Yes, yes.
All right. So with that, I think we can conclude today's session. All right. Thanks everyone for your time and patient hearing. Yes. So I think we are going to meet again on 30th of this month for foreign exchange. So until then, yeah, take care. See you guys. Okay.
Yeah, thank you. Happy
Yes, sir.
Thanks.
Diwali in
Thank you,
advance.
sir.
Happy Diwali.
Thank you.
Happy Diwali, sir. Thank you.
Thanks. Happy Diwali. Thanks everyone. Wish you all a happy festival. Yeah. Thank you. So, session over. Thank you. Happy Diwali, sir. आपको भी.